Hello, Ryan Garland. I am your host of The Paradigm Shift. I cannot wait to expose the true inner depths of institutional wealth building and how to dig deep into real estate investing. Hey, everybody. Ryan Garland, founder and chairman of Paradyme. Thank you very much for joining us today. And for those of you that are going to be watching the recording, I have a sticky feeling this is going to be very fruitful for you. So please take the time and go through the entire video, especially if you're looking to do some business with us. And I think this is going to be, again, very fruitful. So we have today our CEO, Michael Reveley. And I tell everybody he is my secret weapon. He's the guy behind the scenes that's running the day-to-day operation. He'll be with us for almost 3 years now. And it's been an honor to get to know him, not only on a personal level, but his level of knowledge is rather impressive. And that's what I'm going to try to highlight here today, is really kind of the understanding of Wall Street meets Main Street. And Mr. Revly has a background in Wall Street. So we're going to start today with his background, and then we're going to kind of chime in from there from, all of these other little attributes of the company and the things that I think you guys will appreciate how we built out our platform. And today, the idea is to talk about a few different topics, and these topics are going to be macroeconomics. We want to talk a little bit about what's happening from a macro side when we're scaling our projects or scaling our platform and what it is that we look for, down to the family office movement. I think some of you that have that know us know that we're opening up our headquarters and we're actually naming it the Family Office Society. Some people don't understand what that is, so we're going to highlight kind of that movement now, and kind of the interest rate environment, the shifts, and inflation. That's going to be a big topic because that has a massive impact on the forecast of profits on projects and which projects we pick, along with locations in which we pick as well. The effects on tariffs and the risk and how that takes the risks in the tariffs and how that has an impact on all of our projects and really the economy overall. And then the lending trends in construction financing and how we have to navigate those waters more now than ever. And really the idea is to kind of talk more about what the institutional level is looking like, and then how guys like us on the street level have to create that synergy to be successful. So Mike, thanks again for joining us, my friend.
Appreciate it. It's great to be here and great to be on with you. I think should be a fruitful discussion for people. We'll get into the Paradyme platform a bit, and obviously from a macro perspective, get into our thoughts on where we're going to take the company, the things that are affecting us as a company. I think that's really important. Obviously, you and I spend a lot of time sort of going through granularly things that are impacting us, as an entity. Whether it's macroeconomics or cost of copper, right? Everything from,
Literally.
All the way down to how many nails we've got to get or screws we have to get in our next project. So all these things are important for us. I don't think there's nothing too small when it comes to, running a business and in a platform like what we're doing. So hopefully people get a better sense of the things that we think are important.
Yeah, no, and that's exactly it. We have to, the devil's in the details, so we really drill down into that. And that's kind of what we're going to do today. So let's start with a little bit about your background. I think it's really important for people to understand who's really, running the company internally on the day to day. And then we'll kind of show how it highlights what it is that I do and how that synergy has a massive impact on our platform.
Yeah, my background's sort of interesting and I think very different historically, right? And it has moved and it shifted as everybody careers shift. They focus on different things. But when I first really started my career on Wall Street, I was like one of those geeks that was staring at Bloomberg screens all day long, right? And trading, small movements in interest rates and, trying to make money from sort of looking at the big global macro picture and then, all the way down to trading minute changes in interest rates. So very focused on, sort of the big picture and then, but basically trying to pull money out of the markets as different trends changed and volatility increased. Basically I sort of viewed it as I'm sitting on, New York on Broadway and I'm reaching out, I'm sort of grabbing dollar bills as they flow down Broadway, right? That was sort of at one part of my career, my job, just trading and really trying to be really smart in terms of how, I'm analyzing risks, how I'm analyzing markets, and how I'm making money day in and day out without any big drawdowns, right? So that, from a trading perspective, it's very different on Wall Street today. Most of that's being done, with computers and there's less, human interaction, which I could spend like 4 days on that topic alone. Whether that's good or bad, I would say it's created a lot more volatility than it should. So, and then really migrated to from doing that to working as someone at a large institution. This is UBS, large bank operating in the U.S. in the capital markets arena, but working with major companies, all the big borrowers in the U.S., bringing them debt opportunities, so helping them fund their operations and doing so in a way that sort of met their objectives, balancing fixed and floating rate debt, hitting their targets in terms of where they want to raise money on a spread over LIBOR, things like that. So looking at arbitrage opportunities across various currencies and using derivatives to swap back to dollars and fixed and floating, and really just working with the CFOs and CEOs to make sure that they were positioned appropriately as a company, and doing the same things we're doing, right? Reducing the overall volatility of the platform as it relates to the composition of their debt. And then from there sort of gravitated, because this is sort of at a time where hedge funds were sort of beginning to sort of become relevant, and the bank itself was moving into more of an asset management platform. And I sort of got a bug. It's like, look, I just think the equity side, the asset side of the balance sheet is more interesting to me as, it's just as a professional, and sort of got the bug to start my own asset management company, which we did with another partner that had come out of another big asset management company here in Los Angeles. And really our focus was going to be China. And so we're taking my background in terms of trading interest rates, his background in terms of managing corporate bonds, and then sort of migrating that expertise ultimately to China into private equity. Believe it or not, in the mainland of China, we're taking U.S. capital, raising that, and then investing in companies that are pre-IPO situations in China. So that really got me in the private equity. So I've gone from trading to bringing companies funds to raising capital to investing that capital in private companies in Asia, and then sort of took that and sort of brought it out to do it across Asia, Australia in particular. So we brought capital from family offices, from individual investors into Australia. This is post GFC. Things are really cheap globally. So we saw opportunities where currencies were cheap, especially because that's the double whammy. If your currency is cheap and it strengthens, then you're going to have a gain on the currency. And if you do things right, you're going to have a gain, just from the company's perspective as they sort of grow their way into prosperity, right? So we took a lot of distressed companies, brought them capital, and helped manage their way out. We also did some other interesting transactions, which we were taking private companies in the U.S. and listing them in Australia. So very, very interesting time for me, and really sort of put me on the board of directors and operating positions, and then using sort of that Wall Street background in terms of how you position those companies, how you finance those companies, and really and all of that really comes to bear, I think, on the Paradyme platform right now, because of the fact of where we are. I sort of view us in a situation, and we'll go through this, but we're not a small company anymore. From a headcount perspective, we're not a 100-person team, but from a platform perspective, and what we're putting onto our platform and will put on our platform, we've got $500 million, which we're going to be doing over the next 5 to 10 years or more. So these are not little deals. We've got 200 million right now that we're overseeing. So these are big projects, complicated projects, and you and I and the team are managing through the existing pipeline, but also thinking about how we fund ourselves going forward, and how that probably very likely will change what Paradyme looks like, and how we sort of attack. I would say from a macro perspective, how we attack markets across the U.S., right? You've done a great job of being a data nerd on this stuff, where we want to go, where the migration trends are, where land is cheap, where the demographics are aligned with our particular project. And a lot of these are in secondary markets, which takes more work. So, these are all things that we look at, but exciting because I think, and we'll talk about this, I think the overall market from whether it's a private credit side of things, a family office side of things, or a bank side of things, they're looking at secondary markets as becoming their next big thing, right? So we're sort of ahead of that curve right now and putting our assets into those markets that other people are going to find attractive. So,
Mike, you nailed it, buddy. And I really appreciate that because I really wanted people to understand more of your background and kind of really how you understand how money moves and how much you've had your hands in not only in understanding China, but that also going more global really has an impact on tariffs and how you understand it. And we won't get into the weeds on some of our private conversations, but this really kind of does allow us to create a niche and create an edge and mitigate risk all at the same time.
I think you've been in an interesting, right, since 2000, obviously Paradyme predated COVID, absolutely. And we've had projects coming on just very near post-COVID where there's immense volatility in commodity markets and labor markets. And, we're managing all sorts of things, within the platform post-COVID. And we're continuing to see volatility, but we're entering a more normal environment where I think we're going to see capital open up. My expectation is, yes, capital opens up. I think the economy generally does better on a go-forward basis. We may have some bumps here over the next few months, but on a go-forward basis, I think you're going to see probably a little higher than trend growth rates and a little bit more capital available from like the larger banking institutions and family offices for sure. I think, and we're in the private credit sector, so we're a lender as well, right? So that private credit has just been huge post-COVID to fund projects that ordinarily the banks with their balance sheets couldn't do, right? So, I think we sort of sit in a nexus that's super interesting for people because we're a lender and we're a developer, and we're because we start off in the lending side and understanding the metrics that need to go in to make a decision on a project, whether to fund it or not. Those are the same metrics that go into what we're doing on the development side, right? That you start there and then you build out your economics around that project and determine if you're going to go forward or not. But those, that underwriting process is extremely important and is critical to, our construction side. And you cut your teeth there. I mean, I've spent my entire career in sort of this funding capital markets arena. And I think, at some juncture, every company goes from, hey, this is a mom and pop, type of raise to smaller investors, to family offices. And ultimately, boom, it goes to the point where, if you want $100 million, you can go get it. That's not a big deal. The banks are there. The larger family offices are there. But that's a matter of getting to the point where your pipeline is sustainable and you can actually perform. On what you say you're going to do. And that's just simply a matter of experience.
Yep. And how to marry that up. And that was perfect because you'd open up as kind of another way for me to think of it too, or at least explain it. When let's say for our private credit debt fund now, we're ultimately underwriting institutional grade transactions. And the reason is because we do sell our notes. Mm-hmm. So when we fund loans, we know we're going to sell them to a larger institution that has $400 or $500 million in buying horsepower and are actively buying anywhere between $50 million to $150 million a month in assets or loans, very similar to what we're doing with other operators and fund managers. And when you start understanding how to liquidate assets and who's going to be your end buyer, is really how you sharpen your blade to underwrite projects and underwrite those loans, because you know what the end buyer is going to look for. Mm-hmm. So by having a debt fund and really a lending background, now we can really ultimately what you're doing is you're putting zeros behind it when you decide to scale the company or go do larger projects. But the underwriting practices for the most part are the same. And if you're going to go to an institution for a big line of credit or a revolver, like say you're building a subdivision and you have multiple phases, you need to roll that capital as you're liquidating and selling units and you're rotating, what we do now in Paradyme and how our practice is anyways. You need to understand how those revolvers work and what they're going to need to underwrite. And where I think a lot of, and I don't want to say think, I'm going to say I know, because I work with developers that are kind of big children. They see a piece of land and go, I could build this. And that's not how it works. You really have to have the right data and supporting data. And there's a lot of obviously sophisticated people out there, but that's kind of where they come from. They haven't been able to create the synergy necessarily between the institutional guys and then them being boots on the ground as an operator. They have a hard time being able to put it all together properly to then go get the capital that's necessary. And so where the door continues to open up for us to scale is understanding, who our what our exit plan is, and then underwriting it very similar to what we're doing now. So if we're going to look at a piece of land to buy it, now, of course, we're going to scrutinize the heck out of it because it's a different hat in essence, but we're also going to put the deal together very institutionally designed to be able to go get the capital. But ultimately, we have a lot of sophisticated equity partners, and some of these are wealth managers, and some of these guys are, have been in other platforms and work with other guys like ourselves that have invested into. So we had to figure out a way to create a niche and understand the environment well enough. And really the next kind of segment into this, Mike, was to talk about, let's say, a conversation we had this morning. I think this is a perfect time to explain to our network on what it is we're doing and how we're migrating and how we're growing. Because really, at the end of the day, not only Paradyme Storage, but the barn caves has really put us on the map for institutions and larger family offices to really consider us for a larger debt piece, which is ironic because secondary markets never get those type of infusions. Right now, just given the environment, and this is why we want to talk about the microeconomics family office and risk impacts on tariffs and so forth. But let's talk a little bit about the conversation that we had today without going into too many names. But we always say until the fat lady sings, right?
The interesting thing about the conversation that we had today, it's not just a single conversation. This is one conversation of many that we're having with larger players.
We've had the same conversation with the same people. For months and months. This has been a courtship for a while.
Yeah. Well, this is it's a relationship that, I sort of brought to the table, and at the right time, you and I wanted to deploy those relationships at the point where we felt that the likelihood of a close would be the highest. And given our pipeline and given we're monetizing 5 projects in 2025, right? There's a lot happening this year for Paradyme, which has really brought Paradyme to the point where a larger player, if they're looking at a $100 million debt facility, they're going to say, yeah, I can see that. There's your track record. This is your markets that you're in. We understand what you've done. You created a track record that's an institutional track record. So those conversations are what we're having right now as a company, because we're looking forward. If we have a $400 million pipeline, we're going to have to, that is going to be a mix, right? Amidst of family office capital, high net worth, and we're not talking $20,000 checks here. We're talking $1 million, $3, $4, $5 million checks, plus from high net worth, family office, and then ultimately that debt piece. So I think as the conversations that we're having just on the debt side, I don't think we could have had 3 years ago. From the scale that we've been able to operate in and the projects we've been able to complete or in the process of completing this year, brings us to the point where there's believability and sustainability and predictability, right? So whether you're an investor, what are you looking for, right? You're looking for value. Where can you make money? Where do things look cheap? You're looking for safety and consistency, right? So for us, are people looking at us? Okay, well, what do these guys do? What's their secret sauce? Well, we build fast, right? Steel and concrete for the barn caves and storage, and so we're a builder that builds fast, and our cost to build is less than industry competitors, right? So they're looking at value. So this is sort of okay. I get this. I mean, they're in the storage space. They've done this great project that sort of marries their storage with residential, what they've done in other parts of the country. I get the story, and I like them as an operator. This is like immediately when I was in New York and had the meeting, it was like, I get what you guys are trying to do, and I get your edge. And I think if you, that's one of our key points here is we do have an edge in the marketplace in terms of where we are as a market in the secondary markets, which are, which basically that's where the migration is going to. The land is cheaper there. And we can identify the demographics. So they're like, I like those markets. They're now not, I don't want to be in LA. I don't want to be in New York. I don't want to be in Chicago. I don't want to be necessarily in certain parts of Florida. I may want to be in Tennessee. I may want to be in Missouri. I may want to be in Arizona, right? In the secondary markets, because the projects pencil out there. Just land costs alone means it's easier to pencil these things out from a project perspective, and then from a demographics and a migration perspective, that's where people are landing, and it's pretty clear. I mean, that's not going to change. But the way they're looking at us is, okay, they're smart, they're in these markets that we can understand, and their project sizes are not $13 million. Their project sizes are 75, 100. That we're getting into the point where these projects are larger and larger and larger, and those numbers are important, right? The conversation we had today was, if I'm going to give you 100, we want this to be, you got to go fast. You got to draw this stuff down. We want this line utilized, so give me your pipeline that you can actualize over the next 12 months. Right. So from that perspective, I get it. Right. Yeah. This is capital that they have to set aside. They're going to pay 8% on it. So that's a cost to them. They need to be making money, from Paradyme. Paradyme, because of the nature of our underlying projects, we don't have to argue about SOFR plus 300 or SOFR plus 450. It doesn't matter to us. There's enough margin for us that those discussions really aren't key. What's key to us is availability of capital, and then knowing how much equity we have to raise to support, that facility. But these are ongoing discussions. It's exciting for me to sort of see this. I mean, my career, $1 billion was a small number. That's like, okay, that's a rounding error. We're going to bring, from a financing perspective, I was bringing $400, $500 billion deals to companies all the time. That was just what we did on Wall Street, right? And now we're at Paradyme, we're starting to get into those types of numbers, which says something about, about the company that you founded, the company that we're trying to grow together, and the possibilities for us. And I'm not saying this is, obviously we're excited as operators of Paradyme, but I think I'm more excited about our investors and what we can bring to those investors, the opportunities that we can bring alongside that institutional debt piece, that institutional capital piece, to I think really make a difference. Whether it's a small family office, we've got a ton of those now that are in our network, or high net worth individual. I just think, if you look at our platform and what we can bring on, I don't see anything like it. This is the strange thing for me. It's like, okay, as an investor, what projects are coming onto our platform, and what's the competition, right? So where else are you going to put your money? And I've said this before to you, and it just keeps ringing in my head. It's like the variables that we have to manage around to make our investors, their 25 or 30% returns are so small. They're not that large, right? As long as we're smart and we can hedge out some of the macro risks, to be able to bring those types of returns does not require, 1,000 variables. It's very, very short. They're very few. There's 3 or 4 variables. We protect those. Those returns are our investors get those returns. So I think the banks see that, and I think our investors are increasingly, the larger investors are seeing that sort of predictability, sustainability, and the ability to bring sort of outsized returns in a market that's, if you sort of look at it, the macroeconomic environment, I think, is shifting. It's improving. But with that, it's going to take, things will shift where people want to put their money will shift. And, right now, we've sort of seen this sort of, it's from an equity market perspective, the U.S. equity market is lagging most other equity markets, right? So people are saying, I don't know, man, I'm looking for value. I don't think that necessarily the U.S. is providing the value from an overall equity market that I'm going to find outside the U.S. And if you look at that, that's super interesting for me. That's value, like going back to what we do and how we perceive value. Everyone's looking for that. They're looking for value. They're looking for sustainability, right? So I think, if you sort of take things from the headlines and what we're seeing right now, it's like people are looking, away necessarily. They were looking at sort of this AI trend and just throwing money at AI, and 5 companies in the world got all the money. that sort of translated down to everything else too. Like most of the big funds, private credit funds, the huge ones, they got all the money, that sort of thing. Now they don't know what to do with it. I think, it's sort of the same thing with the Mag 7 or whatever. They got all the capital. Now, how do we really deploy it? They're trying to tell the story that we're going to do that through AI, and that could be true or not. But I think the market's beginning to say, well, you're expensive. Let's go try to find other ways to basically safer ways to create a return. And they're going to be looking a little bit downstream. So I do think from a risk perspective, people are going to be trying to look at opportunities like Paradyme. Forget the top 10 capitalized company in the world. Let's move down the value chain. And within this environment, if we're going to see slightly higher economic growth, we're not growing at 1.5%. Maybe we're growing at 3% or 3.5%. And then through this tax, through the great big beautiful bill, there's lots of incentives there for smaller companies to write off 100% write off for equipment, right? There's a lot of stuff in there for the smaller companies where they can really use that. The bigger companies, maybe not so much, but the smaller guys can take advantage of this. And so I do think I'm pretty bullish longer term about where the U.S. is from a real estate perspective, not so sanguine about like financial assets, equity assets, that sort of thing. But I think from hard assets, real estate in particular, I think we're going to have a tailwind. I really do, because I think overall, if I look at interest rates, they're sort of stable. We got a really flat curve. The Fed's sort of on hold for the time being. But I think the Fed begins to sort of look at the overall economic environment and say, look, inflation will come down. We're going to be able to lower rates, because the U.S. from a rate structure is way higher than Europe, for instance, or Japan or Australia. We're just at a very, very high level of interest rates. So there's no reason for the U.S., other than this terrible post-COVID inflation push, to have rates where they are, right? I think you look at the longer trends, inflation's trending down to 2%. That means you're going to have a shift in the yield curve. It's going to be upward sloping, but you can have lower rates overall over time, right? So from a real estate perspective, nothing's more geared towards interest rates than real estate. And by the way, we're from just a housing perspective, we need to fill 5 to $7 million homes in the U.S. over the next 5 years, just to sort of catch up to trend. So if we get that sort of steepening the curve, rates lower, then I think, maybe the dollar a little weaker too. Part of this, I think Trump is sort of a weaker dollar guy. And with this whole tariff discussion, what he's really trying to do is bring capital into the U.S., get supply chains sort of formed here, and then, work on exports. So with that sort of export focus, he's going to want a little bit of a weaker dollar. So I sort of see that as something that I think people will have to look at in terms of how to negotiate and how to manage their own personal wealth around that. Right, the dollar probably has less purchasing power over the next 5 years than maybe it had when the U.S. was the only game in town. Right, post-COVID. Right, so I think with that sort of macroeconomic discussion and sort of view, that's why I get more and more bullish about banks are going to be healthy. Banks are, I think from a regulatory standpoint, they will have some regulatory relief in terms of their capital that they need to set aside to make loans, because Trump is going to want them out there lending. So I think there'll be some changes from a regulatory standpoint that is going to free up some of that embedded capital that banks have. And they're going to want to get into projects, like what we're doing, right? That's going to be quick projects. You're in and out in 5 years. There's a ramp up period. There's a build period, but these are not office, 50-story office towers, shopping malls, what have you. These are, storage, residential focused MFR projects, which I think are imminently fundable. So I think just from a tailwind perspective, and going back to our conversation today, I think that's exactly what they're seeing as well. It's like, let's go find projects which are a little bit off the runway, or not projects, but let's go find managers or developers, people like ourselves, which are doing things that are, not right down the center of the fairway, but they see the value proposition and the deliverabilities that we can bring to them. So I think very smart banks, very smart private credit, the bigger shops are looking for ways basically to say what we've been doing for the last 5 years is not going to work over the next 5 years. We've got to find something different, and they're looking for people like Paradyme.
You nailed it, Mike, and I really appreciate that. There's a lot of fruit in there. And I'm going to kind of give a little bit more color too on maybe the more microeconomics I focus on, because clearly you just were talking at a much higher level on the overall governmental side down to, institutional and how the institutional market is really shifting. I'm going to kind of back up a little bit. So the Paradyme, a lot of people have been asking me, how the heck are you guys growing in such a unique environment? And I tell everybody, where I actually built my business is in the distressed market after 2008. I was a conventional lender, and I was doing some hard money prior to that. But after the market crashed and losing everything, I ended up kind of rubbing elbows with a high net worth guy that wanted me to stay on the mortgage-backed security side and start doing more private lending and acquiring distressed assets. And that's how we were getting, much lower loan to values and acquiring assets at a much lower price. And that's when I really started learning that for you to make money, it's all about your acquisition price. We're bringing that practice to our table now. Hence secondary markets acquisition costs for land. The other side of it is I had a very unique, I would say, vantage point. I actually was introduced to a gentleman who was actually providing back office services to the largest auction platform in the world, which was called REO Max. So back in 2008, and this is some of the details I really want to drill down into giving some of our network, because I think not a lot of people know this about me. But in 2008, when the market crashed, the FDIC really didn't have the liquidity to be able to bail out all these banks. You got, for those of you that were in the space, you had Wachovia. I remember Wachovia got purchased. You had New Century, Countrywide. And what happened is I actually was in the right place at the wrong time and was introduced to a gentleman to open up the door for me to come into an auction, like literally on a day where I was watching billions of dollars of distressed assets and banks being bought by other billionaires, not the FDIC. This was people that were coming in and actually buying these banks. What this gentleman was doing was actually providing the back office services for asset management. So that saying that the people that made a bunch of money during the gold rush were the ones that provided the picks and the shovels, right? That's what this guy did.
Yeah.
Yep. So he was very smart. He brought a bunch of analysts in. He had all the software and technology at the time, and he would go to these billionaires and say, "Listen, you don't have the back office, but you got the liquidity. Yeah. Why don't you come in and I'll introduce you to all these banks, the Wachovias, the B of A's, all these distressed portfolios. You can buy them, and then my asset managers in the back office will offload these and focus down to the macroeconomic side of these things, because they're buying 2,500, mortgage-backed securities, 2,500 foreclosures, 3,000, 5,000, 10,000 foreclosures. I mean, it was insane how large these portfolios were, but they were buying them for 40, 50 cents on the dollar. So again, acquisition. Yeah. The other side is how did they repurpose those? And this is where getting into private money and dealing with fix and flips and working from more of a street level, I was able to identify what they were doing. So just to kind of give you some additional detail, inside this auction block, what they were doing is they were providing what you call heat signatures. They were able to collect the data on remember the option arms and the negams and 228 LIBORs and, adjustable rate mortgages and all of that fun stuff that people were really pushing into. What was happening is they had all the data on all of those mortgages, how many different, so all the way down to, let's say, Pulte Homes, KB Homes, Standard Pacific Homes, they had their own in-house lender. They were able to identify even the track of homes that were being built and what those lenders were providing those buyers, the 228 LIBORs and so on and so forth. And they were narrowing it down to zip code. Well, with what was on for the foreclosure books or what was a notice of default, not quite foreclosure yet, they also had a metric that would track, okay, you have all these that are currently in foreclosure going to an auction. You have all these that are in notice of default. And here are the ones that we expect to come up. So what was happening is they were ultimately offloading assets that were performing, in the middle of non-performing, and full tilt non-performing. And what was happening is I was watching them on how they were narrowing down to how many women were on, how many wives or how many women owned homes individually, down to married couples on mortgages, to just men, that so on and so forth. And so the devil in the details, in essence, was so impressive on how they're narrowing that down, and really the migration trends, the spending habits, the educational levels. generational trends, spending habits, all of that fun stuff was being implemented in this auction to project the asset value of these portfolios. And that's where I really started understanding the level of detail that you have to implement to underwrite to be able to, in essence, make a lot of money. And this is where these guys were making a lot of money. So when the pandemic hit, now obviously coming through that, and I'll touch on one thing. So if for those of you that were really knee deep into this, there was a Forgiveness Act, which Obama released some policy where if you short sold your house instead of go through a foreclosure, the debt was forgiven. That deficiency from what you sold the house for and what you owed on your mortgage was forgiven. And then he obviously opened up the Kickstarter program, which allowed investors or operators like me to start soliciting, doing mass solicitation to raise capital. And that whole Kickstarter program was really to kickstart the economy and get because small businesses, are the ones that employ the majority of our people, right? The U.S. Is really driven by the small business owners. That's where you see Trump right now is trying to create that small business growth by his policy now. So it's really kind of that whole idea of like understanding just how things go and how things happen, back in the day and how much things are happening now and seeing it kind of lay out for what it is. And then we're just implementing those growth strategies. And really the idea is people go, oh man, you really blew up during the pandemic. Yeah, because this is where I saw the opportunity going. The worse the market gets, the more money we're going to make. Yeah. And so I actually looked at this as an opportunity of going, okay, this is when we start acquiring. People are going to have to start offloading all the way down to, and I hate to say this, but it's true, divorce rates and unemployment. We track all that all the way down to baby boomer spending habits and migration trends. And all of that is obviously all over the news. Back in the day, it wasn't there. We didn't have the data software systems and technology that we have today. So it's a lot easier to understand the markets because that technology is now in place. So it takes a lot of the guesswork out of it. And it's really just kind of, black and white, positive, negatives type of thing. So that's where understanding the macroeconomics is a big deal because, again, it's that devil in the details and really understanding it. So let's roll from there. Let's go ahead and transition into the family office because we really did talk high level at institutional grade. And I would like to, I've been telling people, again, you went from Wall Street to Main Street and how a lot of wealth managers are leaving the larger institutions on the wealth management side and coming down to more of the street level and going more mainstream, but how that actually provides a little bit more of a higher touch platform. As an example, back in the day when you had all those foreclosures, you didn't have the asset managers that were just behind a desk and looking at numbers. They didn't have the intimacy and intimate details of each asset and the political environment in the area or what area has high crime rates and where these things are going to trade, right? It's really kind of understanding each location that, that those assets were in. We, as a fund manager, when you have a debt fund, as an example, a mortgage-backed security fund, every asset we lend money on, we're a lot more involved in that. Not only do we lend the money to them, but we're watching over that project as it's going through construction throughout the life of it. So we have a different vantage point to be able to watch how things are going on. So we're intimately involved into every asset that we manage, where banks just simply don't have that process. So let's go ahead and dive more into the family office, Mike, because I think you have a really good way of teaching people what that is.
If you look at the family office growth and just the emergence of a family office, this is like one of the most important changes that I think the U.S. has sort of seen. And it'll continue to really change the landscape about how things get funded, how investments get made. And so it's a really interesting discussion, right? So what is a family office? Well, a family office is nothing more than, hey, somebody made a bunch of money in, they had a chemical company, or they had a real estate company, or they had, a manufacturing company, and they accumulated, usually it's multi-generational wealth, right? They get to the point where they need to create an investment. It's an investment company that's going to sit back either from the cash flow that's being generated from that underlying operating business or from selling that business. The money goes into essentially a group of professionals, CIOs, attorneys, big staffs that are essentially nothing more than fund managers that manage those pools of assets. right? And so it becomes, for people that are, let's say, Paradyme, all of a sudden we're like, okay, well, this is a pool of capital that is available to, from an equity position, from a mezz debt position. They want to be super creative in terms of how they deploy that capital, but but think of it as a pool of money, right? So a family that has that money, they're taking risks. They don't want to overexpose themselves on this pool of capital, right? So this is the generational money that's going to basically have this family living its best life for the next 5 to 10 generations. So when you have a chief investment officer sitting over that pool of capital, there's usually, and there will be, an investment committee, right? Just like if you have a PIMCO that has an investment committee, right? You have fund managers that are looking after certain, whether it's real estate or it's private equity or it's, you name it, more liquid investments. They have portfolio managers, whether it's 1, 2, 3, that are just analyzing all those risks all the time. So these are professional, effectively, money managers that are deploying capital, and they're writing loans, right?
They're seasoned in underwriting and vetting, and yeah,
absolutely. And so this is sort of an extension, and they pull those people out of Wall Street. They pull those people out of some of the endowment communities and pension funds, people that have been in that sort of seat, CIOs and deputy CIOs that have been in those seats before and know how to effectively not only deploy capital, but manage the capital and manage those investments once they've made them, because that's the ongoing decision. Do you want to stay in this, or do you want to migrate to something else, right? So that's the job of the portfolio manager. But as the U.S., I see this as just this pool of capital is going to get bigger and bigger and bigger and bigger because of the amount of wealth that's been created in the U.S. Real estate's obviously a huge part of that, but other companies that have come up, they've gone public or they're private, and they're going to be selling those businesses. So this pool of capital is just getting bigger and bigger and bigger. So that the quest for Paradyme and for people like us is, how do we communicate with that family office? What are the things what are they looking for? Can I understand what they're trying to accomplish as a family office? What risks are they trying to hedge out? What risks are they trying to take on? So you really have to assume a portfolio manager's mentality as you approach those family offices, and then structure deals which fit within those risk buckets that they're trying to manage against. So that, it's been a fascinating sort of period, I think, and it's really over the last 10 years, this has really become something that you pay attention to, and you actually are trying to locate those family offices and pitch to them. And I think that absolutely is a trend that we're going to see grow, and it sort of it's competing with private credit, it's competing with bank financing, it's competing, for private equity. They're trying to become their own private equity shops too. So it's changing the landscape of how capital gets deployed and how capital gets raised, by, let's say, a Paradyme, right? So it's purely portfolio management. And it's interesting because the bigger picture on these guys is they've created the wealth. So they're not necessarily looking to take huge risks. They'll have a 10% of their portfolio, which is like, hey, let's go for the home run. But if that goes to zero, they don't care as much, right? But that's 90% of their other buckets are things that aren't going to lose them a bunch of money, right? This is about creating, if they can get 9 to 12% returns, they're happy as a fat clam. They're like, done. Buffett used to say, if you can compound money at 10%, you'll own the world, in your lifetime. So you don't have to get 30% returns all the time. You can have buckets that are going for those 30, 20, 30% returns. And a lot of that is sort of in that sort of PE bucket. I have my own thoughts about the PE bucket. I don't think family offices are particularly good in the PE space, right? For lots of different reasons. But for those other buckets, whether it's real estate or, equities or bond trading, and they're great at that stuff. That's just, it's easier to manage and to navigate around. But again, these guys are like, they're trying to create generational wealth. They're trying to say, what's the inflation rate? How do I grow this pool of money above that inflation rate? And if the dollar goes to zero, where's my hedge there? Because their assets are in dollars, but they want to maintain a lifestyle where they can be anywhere in the world enjoying it. And therefore, they can't just look at their investments as just dollar denominated portfolios. They've got to, they're looking at this like, I've got to outperform, in not only just dollar terms, but in sort of global currency terms. So there's that picture of it too. It's like they're really looking at this holistically as wealth preservation and wealth growth. And again, I don't know what the size of this. I actually should know that. I don't know the size of the family. It's fairly opaque, but it's hundreds of billions of dollars that are
and growing. It's one of the fastest growing movements in the wealth management side.
Exactly. So you'll be you'll be a multi-trillion dollar pool of capital that the U.S. in particular, has going. I mean, it's amazing the capital in the U.S. that's available, whether it's a financial system, Wall Street, private capital from family offices, high net worth individuals. That's a really, versus any other place in the world, whether it's China or Europe. The U.S. is so different. Our capital markets are so robust. There's so much capital that can be deployed. It makes it from a company like Paradyme's perspective, we just have to think smart, right? So how do we grow and scale the company, knowing that the capital is available, but knowing we've got to basically, we've got to tune what we're doing into those risk buckets so they can say yes. And that's generally what we do. Old school would have said, you just go to a bank and they'll lend, to put 20% equity, they'll lend 80%. And, but those days are over. You've got to have discussions with private credit shops, with banks, with family offices, with high net worth. And even our crowdfunding platform, we're seeing, that as that scales, we're seeing real advantages where guys are coming in, they're writing $3 million checks, $4 million checks, right? So we're getting through some of that effort. We're sort of getting into some of these smaller family offices with, let's say, $100 million to manage, right? That's, as a family office go, that's small, but those guys don't have the resources that some of the bigger family offices have, right? So they would really want to partner with people like Paradyme. They get to understand what we're doing and the repeatability and sustainability and what that pipeline looks like. It's very attractive for those people because they are more relationship oriented as opposed to some of the larger players.
And I'm going to add to that, Mike. Mm-hmm. One of the things that I've been kind of caught my attention over the last few conversations we've had with some other family offices. We're really educating them now. They're very sophisticated in managing money and understanding from a global level or some macroeconomics level of, moving money around and kind of where things are heading. What we're realizing is that a lot of these wealth managers that are really starting to allocate more capital to alternatives and specifically real estate, when they're more of a Wall Street background, they don't really have the real estate knowledge. They may have, bought and sold some of their own homes and so forth, but they don't really have that type of knowledge. Their education's at a different direction. Mm-hmm. What we've done is we've kind of created what we've done is we've been honest and opened up the floodgates of how this works. A lot of people don't want to share the secrets or the secret sauce of what's going on. And that's not how we operate. We're going, listen, this is how it is. And this is what we're seeing. And here's the proof of it. And here's what we're buying the material for. And, this is how long it takes to build it. And here's the track record, right? We're just kind of saying, this is where it goes. If you want to try to mimic it, good luck. It's a whole different level of management when you're dealing with people and herding cats on site. But it's a different environment. A lot of people, because the nature of investment right now is going towards alternatives. Again, a lot of gold, silvers and so forth, even that. But what's happening is when we're talking to a lot of these wealth managers that are saying, hey, look, I have a mandate to allocate 10%, 15, 20% even to alternatives and mostly real estate. We need a firm that we can trust that's going to provide kind of a red carpet service, but really educate us and allow us to have an open book kind of conversation. And that's where the trust is made. It really is kind of talking about the hardships of what we've gone through in the past, like, again, our track record, where I understood macroeconomics, kind of what I was talking about with REO Mac, down to what we've done and implemented, the mistakes we've made and how we're correcting those mistakes. And really each individual too, that has a big stick within the company and the decision-making that they have in their track record. That's really what's happening too in the space, is that people are really wanting to trust the right operators. And the way to do that is to say, come to our site, meet us, and then let me show you how it really goes down. And that's where the education and knowledge is coming in. So family office, because there's such a shift in the market, that's why we're talking about the trends. Really it's a high level set of education now. We're having conversations of why we look at things the way we look at things, how we're underwriting the things, why we have a construction management division, and how that married up to fund control and the debt fund, and how that was seamless to oversee. And why did we choose this to our underwriting background on assets throughout the country? It's really kind of understanding what we're able to do is articulate it in a way where it's that makes sense, and then show third-party data that is supporting our decision making.
They also get data. They also get, like you said, they get data from us, right? Just think about, big picture real estate. Everybody macro understands real estate, and there's been a tremendous amount of wealth that's made in real estate. It's a real asset. It's a hard asset. People love it. So it's got all this halo effect, which people generally feel good. Oh, I like real estate, right? But once you get into as a developer, and get into these projects, we've got like data on so much stuff. Like if you say, let's talk about the input costs that are going into our projects. Where are they? Up, down, sideways, right? If you want to get a peek about inflation, copper, steel, rolled steel, it's up 20+%. But it's flat year over year, up 20%. Really since the tariffs. Copper, it essentially, we saw copper through COVID spike like 2 times, and it's come down. Basically, it's up 3% year over year. These granular things, lumber prices, another one, right? So we're dealing with this from an input perspective. That's our core business, and managing around those core businesses. And that's information that I think is really useful. People love that stuff. It's like the data that we get from our underlying operations are incredible. From if you're a data nerd at a family office and you're trying to make decisions about where inflation is going to be, or where banks are, where liquidity in the overall economy is, and where capital flows are coming, this is all information that basically is really, really helpful. So I think having, like you said, having an operator that they can, when you make an investment, if you can't describe the investment in about 30 seconds, it's probably not a good investment, right? So from a simplicity perspective, I love that. Meaning you can get in front of a family office, describe how you're going to build a storage facility out in probably 10 seconds. It's like, for you, it's like done, right? Here are the inputs, here are the costs, here's the land cost, boom, 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 boom. Start to finish is a 2-year everything you can describe in a very, very short period of time, because you've got it. It's simple and it's repeatable. Same things with our multifamily side of the business, right? So I think that from an investment thesis standpoint, not only is it understandable, but people get valuable information about overall economic data from operators like Paradyme.
And let's from there, let's move over to tariffs, because we have a little bit more time left. So because you brought it up and it caught my attention, I want to actually shift into that. So a lot of people go, hey, what are you doing with tariffs? The 90% of our conversations, that part of it does happen within our conversations. And what do we do to hedge against inflation? So what we've created is really a relationship. So when you get to a certain point, and this is why people talk about how, one or two operations within a city kind of dominates the space, right? You have one contractor in Lake Havasu that really kind of gets control over the majority of the transactions. It's the nature of certain businesses. That's what's happened with us. We are acquiring so much steel that we are able to have a senior position inside these manufacturers. What we've done is we've screened the existing manufacturers and new manufacturers to find out where they're getting their steel from. The majority of our steel right here in Arizona is actually coming from Mexico, which isn't being as impacted nearly as much as what was happening with China and all the stuff that's going on, and we won't go too far into it. But that's huge. And what we've also caught is that a lot of our manufacturers have been very smart. They've been stacking the deck with old steel that they can actually recycle. And so we're doing much larger orders earlier on to try to lock in our price. And then one of the things that we did that was probably a little more outside the box was, for those of you that know us, you'll know how many units we have at Paradyme Storage. We have Boathouse, we have Dover. What we decided to do was go ahead and do a mass order of all of the garage doors for every one of our projects in one shot. And what that did is it allowed us to compress our costs. And here's where the big thing is you see it all over the news and everyone's all stressed out about it, and rightfully so. But what's happening is guys like us have a personal relationship with these manufacturers, and they don't want us to be out of business either. They want to try to ride this wave as well. So they're inheriting some of those costs while we're inheriting them as well. And so having an open book contract is really important, an open book plus a cost plus contract. So what's happening is we're not feeling it as much. We're feeling it, but so is everybody that's involved. And they want to obviously supply some of their bigger buyers. So we're going to get a senior spot. What we did with all those garage doors is we did one big order out of China to order all of the garage doors in one shot and have one container delivered. And the delta was only a $30,000 difference for all of our projects and cost. Yeah. So it's those type of decision making just to move quickly to get that stuff locked in so we can fulfill the commitments that we've already taken to get the projects completed, all the way down to our HVAC and so on and so forth with Paradyme. We ended up ordering all the units all at once and saving almost $200,000. So there's things like that. When you have cash is king, when you have the buying horsepower, things shift. We're also one of the larger contractors here in Havasu, so we're employing more subs and for longer periods of time because our projects are so big that the line items are longer. So you're going to get different treatment. And I hate to say it from I hope I don't sound arrogant, but that's just how it works. And what's happening is we're continuing, we keep the respect high and we're keeping people moving forward. So we have to make the right decisions to keep our downline fed too. So it's not just our investors or our operation and us putting foot on the table. There's a lot of people involved and we have to make those decisions sometimes on the fly. But right now we seem that we've made those decisions have been good. And I think we're, like you said, we do have some tailwinds coming, Mike. So I'm not stressed about it. I think we all agree that things are starting to shift, inflation's come down, so on and so forth. So with that said, that's some of the things that we've seen during the tariffs that have an impact on us. I think a lot of stuff that you see on the news is I think it's a bunch of high school kids fighting, and it's not as aggressive on the ground. And that's where I wanted to take the time today to educate, our network that we're not feeling it to the impact that I think most people are fearful.
Yeah, I think that's right. I mean, we wrote. I mean, that's the nice thing about us too. We do a quarterly. For our secured income fund investors, we spend a lot of time sort of on this macro side of things. So I think people are interested in it. And, our impression was, wait a second, these tariffs. Yeah. Let's not stress about the tariffs. It's a negotiation. To be quite honest with you, I think, trade isn't free. There is no such thing as free trade. And I think Trump has sort of recognized that. And therefore, let's normalize, those tariffs across countries and get them ultimately to remove their... Again, this is not about erecting trade barriers as much as it is reducing trade barriers in other countries. Sure, maybe there's a 10% tariff globally, fine on everyone. I think the market can get past that, not a problem. It's from his perspective, it's about removing and reducing trade barriers so U.S. can export, whether it's ag or whatever products we're exporting to those countries. It's more about removing those barriers as opposed to So I think we had the right take on it. And I think the market, was down, 20% almost on this sort of tariff hysteria, and then has bounced right back, right? So I think people are getting, sort of wise to ultimately what we're trying to do here, or at least the Trump administration is trying to do with the tariffs. But, your conversation sort of ground up, micro, granular is like you got to value engineer constantly your budgets and find ways, to save in other areas if you're going to spend more in this area, right? So I constantly hear you value engineering every piece of the project as we go through it, not as we go through it, but looking forward and saying, should we pull forward costs? How, and what's that going to mean to the overall project? What does that mean for our lines of credit? From a budgeting perspective, those are decisions that you make all the time. And I think our development team does a good job of value engineering and finding those ways to save money. And even looking at things, on a bigger picture level. Do we, as Paradyme, set up Paradyme Manufacturing? We've talked about that before. Like, are there things that we can bring to the table that, from a manufacturing perspective, we can manufacture our inputs into our projects to try to basically then protect margins for our individual projects, right? So if we're making the steel, if we're making the garage doors, if we're making other inputs that go into the barn caves or go into our storage projects, then we're going to find ways basically to shave costs for our investors at the end of the day. And so I think as a business, we're looking into the solar area. We're having solar on our projects. Paradyme Solar is a company that we're going to be, getting online as a company. So looking at ways basically to horizontally and vertically integrate so that we can bring to bear pricing power, as we develop our projects at the end of the day. So that, these are decisions that Paradyme makes as a company all day long, and are trying, as we grow, there'll be bigger and bigger decisions that we have to make in terms of scale and how we scale up the business. Ryan, I think you hit mute.
Sorry, buddy. Can you see me too?
I can see it. Yeah.
There we go.
Yeah.
Perfect. Yeah. So I really appreciate that, Mike. I think we've been able to shed a lot of color on kind of the marriage between you and I, and how you and I both see things, and how that implements into Paradyme's platform. So if there's anything else you want to add, my brother, I think we are pretty much good to go. Yeah, no, I think that's we covered a lot of territory here, and these things are always hard because, we could probably spend 3 or 4 hours on a discussion like this. And, I always get calls after these, like, why didn't you cover that one? But I think, look, I think Paradyme is an institution. I think going back to your vision, I love this. I mean, I love this every day because I'm taking what I've done in my past and I'm applying it to a new area, right? To a real estate company that's embedded in lending and ground up. I love this, of what we're trying to build together. And I think, that's exciting. I think if you don't have the energy as a company, you're not making the right moves as a company. That's how things get stale and don't grow. This company is just the opposite, right? There's so much energy right now within Paradyme. We're constantly looking at, what our pipeline is. How can we raise capital? How do we get more money in the security income fund? What's the next project that we're doing in Lake Havasu, right? You're having those discussions right now. You come back to me and say, I just found another one. Let's go raise some capital for it. Or I've had this thought. There's a distressed opportunity over here that I think we should be navigating into, right? So it's, from a platform perspective, I couldn't be more excited about where the company's going and what we're going to do over the next. It's not, like I hear people that are running companies, sort of look at the next 10 years. No, I think it's so exciting over the next 2 years. The next 24 months are going to be really, really different from Paradyme's perspective. And looking back on it, I think even you are going to be sort of excited, maybe a little bit shocked how far this company is going to go over the next 24 months. And it's a testament to the team too, Mike. I mean, I feel honored to have everybody, that's in our back office or downline. I mean, we couldn't do this without the support.
Not at all.
I try to tell Brianna to jump on video conference calls with some of our clients, and she's like, I don't want to put my makeup on today. She's so funny, but we have the best team, and I feel completely blessed. And I think what we've realized is that we can utilize systems and technology to keep our overhead low. Mm-hmm. And we've really brought in a higher level of professionals to really take control over each department. And not only that, we've all been together for a while now.
Yes.
And that really is a marriage, truly. And when you don't have as much turnover within a company, I think that's really important too. And that's obviously what Family Office decides to ask.
Yeah.
but I feel blessed. I feel like we're on the right track. I think what it comes down to is keeping our head down and pushing hard forward no matter what, and really kind of having that understanding that no matter what happens, we're in this together, you know. And I feel really good about where we're going to. So thank you very much for today, and I'm actually looking forward to for our network and our audience to respond, ask us questions. We're going to go ahead and send this out in a recording to our entire network. And for those of you that registered, wasn't able to make it, thank you for watching the video. And really, guys, I appreciate all the support after all the years. And I see a lot of people, familiar faces, and I'm really looking forward to the next one. So guys, thanks so much. Mike, thank you very much for the color, man. You did great. Thank you.
Thanks, sir.